Did you know that over 90% of trading bots fail to generate consistent profits? Many people think they are a shortcut to success, but the reality is often a lot messier. Trading bots have become increasingly popular in the trading community, and it's easy to see why. They promise to take the emotion out of trading, making it a purely data-driven process that's not prone to human error. And let's be honest, who wouldn't want to make money while they sleep? But the truth is, relying solely on algorithms to make trading decisions can be a recipe for disaster. Another reason why people turn to trading bots is because they think it's easier than learning the intricacies of the market themselves. I mean, who needs to spend hours poring over charts and data when an algorithm can do it for you? But this kind of thinking is exactly what gets people into trouble. Trading isn't just about numbers and data. It's about understanding the market, its trends, and its complexities. And let's not forget, trading bots are not foolproof. They are created by humans, and humans are prone to biases and mistakes. Even with the most advanced algorithms, there's always a chance of something going wrong. So, before you decide to hand over your hard-earned money to a trading bot, you need to understand the risks involved. The truth is, trading bots are not a shortcut to success. They are not a magic solution that will guarantee you profits. In fact, most trading bots fail to generate consistent returns, and many even end up losing their users' money. So, why do people keep using them? Well, that's what we're going to explore in this video. One of the biggest risks of relying on trading bots is that they are opaque. You have no idea how they are making their trading decisions, or what data they are using to inform those decisions. And even if you do, it's often impossible to understand the complex algorithms behind them. This lack of transparency can be a major problem, because if something goes wrong, you have no idea what's causing it or how to fix it. Another risk is that trading bots are only as good as the data they are fed. If the data is incomplete, inaccurate, or biased, the bot's trading decisions will be too. And let's be real, data can be biased in all sorts of ways. It can be biased by the people who collect it, the people who analyze it, or even the algorithms themselves. And when you add all these biases together, you can end up with a trading bot that's making decisions that are completely at odds with reality. And then there's the problem of overfitting. This is when a trading bot becomes so good at fitting its model to the historical data that it becomes useless in live trading scenarios. It's like a student who memorizes all the answers to a test without understanding the underlying concepts. When the test comes, they can't apply what they've learned into new situations, and they fail. It's the same with trading bots. They might do great in backtesting, but when it comes to real-world trading, they fall apart. Trading bots also lack the ability to adapt to changing market conditions. They are programmed to follow a set of rules, and if those rules don't work in a particular market, they can end up losing a lot of money. Humans, on the other hand, can adapt quickly to changing circumstances. We can adjust our strategy, change our tactics, and respond to new information in real time. Trading bots can't do that. Another issue with trading bots is that they are often over-optimized. This means that they are so focused on maximizing profits that they take on excessive risk. They might make a few big trades that work out, but eventually, they'll make one that doesn't, and it'll wipe out all their gains. And because they are not diversified, they can end up losing everything. And let's not forget about the flash crashes. These are sudden, extreme fluctuations in the market that can occur when multiple trading bots all respond to the same event in the same way. They can cause massive losses, and they are often triggered by events that are impossible to predict. Trading bots also often lack the ability to handle unexpected events. They are programmed to respond to certain scenarios, but if something unexpected happens, they can become stuck in a loop, repeating the same action over and over again. This is what happened during the flash crash of 2010, when trading bots caused the Dow Jones to plummet by 9% in a matter of minutes. In addition, trading bots can be gamed by malicious actors. Because they are programmed to respond to certain patterns, smart traders can manipulate the market to trigger the bot's trades. This can lead to huge losses, and it's almost impossible to detect. Furthermore, trading bots can create a false sense of security. People think they are making money because the bot is doing all the work, but in reality, they are just riding a trend. When the trend reverses, they are left with huge losses and no idea how to respond. And let's not forget about the psychological aspect of trading bots. Because they are making all the decisions, people start to disconnect from the market. They stop paying attention, stop learning, and stop improving. This leads to complacency and eventually to failure. Trading bots also often have poorly designed risk management systems. They might take on excessive leverage or fail to diversify their trades. And because they are not human, they don't have the same emotional response to losses. They won't stop trading when they are down, and they won't take steps to mitigate their losses. In addition, trading bots can be vulnerable to hacking. Because they are connected to the internet, they are open to cyber attacks, and if a hacker gets into the bot's system, they can drain the entire account. Trading bots also have a low level of customization. They are usually one-size-fits-all solutions, and they don't take into account the individual trader's goals, risk tolerance, or market conditions. This can lead to poor performance and eventually to failure. Now, let's take a step back and explore how trading bots operate. At their core, trading bots are algorithms that use data to make trading decisions. They analyze vast amounts of data, identify patterns, and use those patterns to predict future market movements. But this is where things start to get complicated. Trading bots use a variety of data analysis methods, including technical analysis, fundamental analysis, and machine learning. They might look at charts, economic indicators, news events, or social media sentiment to inform their trades. And they might use complex algorithms to analyze this data, identifying patterns that would be impossible for humans to detect. But there are many potential pitfalls here. For example, the bot's data might be incomplete or inaccurate. It might be using outdated data, or data that's biased by the people who collected it. And even if the data is accurate, the bot's algorithms might be flawed, leading to poor trading decisions. One famous example of a trading bot gone wrong is the case of Knight Capital. In 2012, the company's trading bot started making erratic trades, buying and selling millions of dollars worth of stock in a matter of minutes. The bot's algorithm had been poorly designed, and it ended up costing the company $440 million. In another case, a trading bot called Davy was designed to trade on the cryptocurrency market. However, its algorithm was so aggressive that it ended up losing 100% of its users' funds in just a few days. So, what can we learn from these examples? Well, the first lesson is that trading bots are not foolproof. They can fail, and they can fail spectacularly. The second lesson is that you should never rely solely on a trading bot to make your trading decisions. You need to understand the market, its trends, and its complexities. And the third lesson is that you should always be cautious when using trading bots. They are not a shortcut to success. They are a tool that can be useful, but only if used properly. So, what's the takeaway from all this? The takeaway is that trading bots are not a magic solution to your trading problems. They are not a shortcut to success, and they are not a substitute for hard work and dedication. If you want to succeed in trading, you need to put in the time and effort to learn the market, to understand its intricacies, and to develop your own trading strategy. And that's it for today's video. I hope you guys learned something new, and I hope you'll think twice before relying on a trading bot to make your trading decisions. If you have any experiences with trading bots, please share them in the comments below. And if you want to learn more about safer trading strategies, be sure to check out our next video. Thanks for watching, and we'll see you in the next one.